Silver, at $92, making history. With 10 bullish months, PPI just confirmed it, 10 months straight up. No reversal, no collapse, just silver, climbing and climbing until this morning, when one number dropped and everything changed. The government just released data. That wasn't supposed to look like this. And silver didn't wait. It moved immediately. What does that tell you about what's coming for your money, your business, your future? The answer is more alarming than you're prepared for. Welcome to Financial Crisis Explained, the channel where the numbers speak, and we simply translate them for the people who deserve to know the truth. Now, before we go any further, if you found this channel today for the very first time, think of this subscribe button like your morning newspaper. You know, the one you use to walk to the front porch to pick up every single day without missing once. That kind of reliable, that kind of important. Go ahead and subscribe, because what we publish here is not something you want to miss tomorrow morning. And one more thing before we begin, we are genuinely curious. Where in the world are you watching this from right now? Whether you're sitting in New York, Karachi, London, Dubai, or somewhere quiet that most people have never heard of. Drop your city in the comments below, because the story we're about to tell you affects every single one of those places equally. Now, let's begin. The morning of February 13th, 2025 began like any other Thursday on Wall Street. Analysts were at their desks, traders had their fingers hovering, and the financial world was waiting for one number. That number was the January Producer Price Index, the PPI. And when it dropped, at exactly 8:30 in the morning, the reaction was not subtle. To understand why that moment mattered, one must first understand what the Producer Price Index actually measures, because most people hear the word inflation and they think of grocery bills or gas prices or the quiet frustration of watching their savings slowly shrink. But the PPI is different. The PPI does not measure what the consumer pays. It measures what the producer pays. It measures the cost of raw materials, the cost of manufacturing, the cost of getting a product built before it ever reaches a single shelf. Think of it this way. If the consumer price is the final chapter of the inflation story, the Producer Price Index is the opening page. It tells you where inflation is going before it arrives at your doorstep. And what January's opening page said was deeply unsettling. The expectation from economists and analysts across every major institution was 2.6%, a manageable number, a number that suggested inflation was cooling, that the Federal Reserve's strategy was working, that the worst was perhaps behind us. The actual number came in at 2.9%. That gap from 2.6 to 2.9 may look small on paper, but in the language of monetary economics, that gap is a statement. It is the difference between a fire that is dying out and a fire that has found new oxygen. But that was only the headline figure, because beneath that number lived an even more concerning reality. Core PPI, which strips out the volatile categories of food and energy to reveal the structural inflation underneath, came in at 3.6% against an expectation of 3.0%, a full 0.6 above forecast. When the core number surprises to the upside, it means inflation is not being driven by external shocks. It means inflation is embedded, sitting inside the economic system itself, quietly, stubbornly, refusing to leave. The markets understood this immediately. Within minutes of that data release, gold moved. But silver moved vertically. By the time the serious analysts had finished reading the report, silver was already trading at $92 Western spot, a price level that carried enormous weight, not just technically, but historically. That $92 level had been a target, a resistance point, a ceiling that the market had approached before and been pushed away from deliberately. But on the morning of February 13th, that ceiling became a floor, and the speed with which it happened told a story that no headline was willing to print. Here is what that story says to the serious observer. When inflation data surprises to the upside, and a hard asset like silver responds with immediate vertical movement, it is not a coincidence, it is a confirmation. It is the market saying, in the only language markets truly speak, that the purchasing power of paper currency is once again under serious question. Silver does not move like that because of sentiment, or social media, or the enthusiasm of retail investors. Silver moves like that because institutional money, large, calculated, patient money, has already made a decision. And that decision was made before the data was published. The PPI report did not create the move. The PPI report confirmed it. And this is precisely what makes February 13th, 2025 a date worth studying, not because silver reached $92, but because of how it reached $92. And more importantly, what it reached $92 after. 10 consecutive bullish months. A streak so historically rare that even veteran commodity analysts paused when they saw it, because in the entire recorded history of silver markets, behavior like this has only ever appeared at very specific moments in economic time. Moments that, in hindsight, everyone wished they had paid closer attention to while they were still happening. Most people look at a price chart and see a line, up or down, green or red, profit or loss, but the serious analyst, the one who has spent years studying not just markets, but the behavior of markets, sees something entirely different. They see a confession. And right now, silver's chart is confessing something that the mainstream financial conversation is not yet ready to say out loud. 10 consecutive bullish months. Let that sit for a moment. Not 2 months, not 4, not a strong quarter followed by a correction. 10 months in a single direction without a structural reversal. In commodity market history, that kind of sustained directional behavior is not normal. It is not the result of enthusiasm or speculation or a fortunate alignment of headlines. Streaks of this nature, in assets as globally significant as silver, are the fingerprints of something much larger, moving slowly, deliberately, beneath the surface of what most people are watching. To understand the weight of this streak, one must place it inside the context of silver's long and complicated history. Silver is not simply a precious metal. It is not merely an industrial input. Though it is both of those things, silver is a monetary instrument with a memory. For centuries, before central banks existed, before fiat currency was printed, before digital transactions made physical money feel obsolete, silver was how civilizations stored and transferred real value, and that memory does not disappear. It lives inside the behavior of the asset itself, surfacing at moments when the monetary system begins to show its cracks. History offers a precise record of what sustained silver rallies have preceded. In the late 1970s, as the United States wrestled with double-digit inflation, and the credibility of the dollar came under serious global scrutiny, silver embarked on one of the most aggressive multi-month rallies ever recorded, eventually reaching levels that, at the time, seemed impossible. That rally was not driven by silver mining news or industrial demand shifts. It was driven by a loss of confidence in the system that was supposed to make silver unnecessary. In 2010 and 2011, following the largest coordinated global money printing exercise the modern world had ever seen. In the aftermath of the 2008 financial crisis, silver once again staged a historic multi-month climb. As investors, institutions, and sovereign entities quietly asked themselves a question that no one wanted to ask publicly: what is paper currency actually worth? When the printing press never stops running? Now consider the present moment. 10 bullish months. A producer price index that refuses to cooperate with the Federal Reserve's narrative. Core inflation running 60 basis points above what the most sophisticated forecasting models predicted. And silver breaking through $92. Not gradually, not hesitantly, but immediately. The very morning that data confirmed what the tape had already been signaling for weeks. This is not coincidence layered upon coincidence. This is a pattern, and patterns in markets do not repeat accidentally. They repeat because the underlying conditions that created them have returned. But here is what separates the serious decision maker from the casual observer. The question is never simply what is happening. The question is always, what is this telling me about what comes next? 10 bullish months in silver tells the informed analysts several things simultaneously. It tells them that institutional repositioning has been underway, not for weeks, but for the better part of a year. It tells them that the smart money, the patient money, the money that does not appear on financial television, has already made its decision about the direction of real versus paper assets. And it tells them something perhaps most important of all, that the window between early awareness and public realization is closing. Because here is the brutal truth about every major monetary shift in recorded history. By the time the mainstream conversation catches up, by the time the headlines confirm what the charts already showed, by the time the average investor, business owner, or entrepreneur finally feels comfortable enough to act, the most significant portion of the move is already history. The 10 months are already behind us. The question that now demands an answer is what the next 10 months are being quietly constructed to deliver. And the answer to that question lives not in the price of silver alone, but in the architecture of the market itself, in the patterns of behavior that most participants never learn to read, until it is far too late. There's a word that makes serious financial analysts uncomfortable, not because it is inaccurate, but because of what it implies. That word is manipulation. Say it in a boardroom, and people shift in their seats. Say it on financial television, and the conversation moves on quickly. Say it in an academic paper, and the peer review becomes suddenly very complicated. But here's the precise and uncomfortable truth. Manipulation in commodity markets is not a theory. It is not the language of frustrated retail investors looking for someone to blame. It is a documented, studied, and in several landmark legal cases, proven market mechanism, and silver, of all the assets in the global financial system, has one of the longest and most meticulously recorded histories of exactly that behavior. To understand what happened on that February trading day, when silver touched $92, was halted, and then slammed to $85 within a matter of hours, one must first understand the architecture of how modern commodity markets are designed to function, and more importantly, how that design can be weaponized. Commodity markets operate on the principle of price discovery, the idea that buyers and sellers, through the natural friction of their competing interests, will arrive at a price that reflects true value. It is an elegant theory, but theories do not always survive contact with reality, because price discovery only functions honestly when all participants operate with equal access, equal information, and equal ability to move the market. And in the silver market, those three conditions have never existed simultaneously. What happened between $92 and $85 on that February day was not random volatility. It was not panic selling from retail investors. It was not a sudden shift in industrial demand data or a geopolitical headline that changed the calculus. What happened was a textbook example of what serious tape readers call a liquidity purge. Here is how it works. When price reaches a significant level, a level that has been watched, discussed, and targeted by a large number of market participants, there exists beneath that level a dense cluster of stop-loss orders placed by traders who entered long positions, expecting price to continue higher, but protecting themselves against the possibility of being wrong. Those stop-loss orders are not invisible. To participants with sufficient market access and position size, they are readable, locatable, and most critically, exploitable. A coordinated push downward through that cluster of stops triggers a cascade of automatic selling, which accelerates the price decline artificially, allowing the architect of that push to accumulate positions at significantly lower prices before the real move resumes. This is precisely the signature that appeared on silver's chart when price was pushed from $92 down to $85. The 150-period exponential moving average on the hourly time frame provided the technical confluence point, the level where that downward push found its natural exhaustion. The swing failure pattern that emerged at the Tuesday 9 a.m. New York low was the market's own confession that the selling pressure was not organic, that the low had been manufactured for the specific purpose of harvesting liquidity before continuing in the direction the tape had already been indicating. Price took out that low, triggered every stop beneath it, and then reversed, with a decisiveness that left no ambiguity for those trained to read it. This is what tape reading reveals, that markets are not chaotic. Now, they are choreographed, not every moment, not every tick, but at the significant levels, at the moments that matter most, the behavior follows a logic that is consistent enough, across enough time frames, across enough assets, across enough decades of recorded market history, to constitute a pattern. And patterns can be studied, patterns can be anticipated, patterns can be used, not to exploit others, but to refuse to be exploited yourself. This is where the conversation becomes directly relevant to every entrepreneur, every business owner, every serious decision maker watching this right now. Because manipulation does not only live in commodity markets, it lives in the narrative surrounding those markets. It lives in the data that gets emphasized, and the data that gets quietly buried. It lives in the timing of announcements, the sequencing of headlines, the careful management of public perception around assets that powerful institutions either want to accumulate cheaply or want the public to abandon prematurely. When silver was pushed to $85, the narrative was available immediately. Silver retreats from highs, rally loses momentum. Analysts revise targets downward. That narrative was not an accident. It was the accompanying instrument to the price movement itself. And the people who read that narrative and made decisions based on it handed their positions to the very institutions that manufactured the move in the first place. But here's the principle that every serious student of markets eventually discovers. Manipulation, no matter how sophisticated, no matter how well-resourced, no matter how carefully constructed, has a structural ceiling, because manipulation borrows from the future every artificial suppression of a price that the underlying fundamentals do not support creates a compression, a tension between where price is and where the weight of evidence says price belongs, and compressed springs do not stay compressed forever. The longer the suppression, the more violent the eventual release. 10 bullish months is not just a streak. It is the sound of a spring that has been held down for a very long time, finally beginning to move. There's a particular kind of silence that falls over a room of serious people when they finally understand that the rules of the game they have been playing have quietly changed without anyone sending a formal announcement. No press release, no emergency broadcast, no carefully worded statement from a central bank podium. Just the numbers sitting there, telling the truth to anyone disciplined enough to read them without flinching. Silence is where this conversation now lives. And the question it demands is not whether silver reaching $92 is impressive. The question is, what $92 silver, in the context of 10 consecutive bullish months and a producer price index that refused to behave, is actually communicating to the serious decision maker about the environment they are now operating inside. Begin with the most fundamental reality of the current moment. Inflation is not cooling the way the official narrative requires it to cool. January's PPI came in at 2.9% against an expectation of 2.6%. Core PPI arrived at 3.6% when the most sophisticated forecasting models in the world were expecting 3.0%. These are not rounding errors. These are structural signals embedded inside the data that tell the informed analyst something deeply important about the direction of purchasing power. When the cost of production stays elevated, when the prices that manufacturers pay to build things refuse to fall, those costs do not disappear. They travel forward through the supply chain with patience and inevitability until they arrive, fully formed, at the doorstep of the consumer and the business owner alike. The PPI is not a lagging indicator of what has already happened to your balance sheet. It is a leading indicator of what is about to happen to it. Now consider what this means for the entrepreneur and the business owner specifically. Every business operates inside a cost structure: raw materials, labor, logistics, energy, financing. And every one of those cost categories is sensitive in ways both direct and indirect to the broader inflationary environment that the PPI is now measuring and reporting with uncomfortable honesty. When core producer prices run 60 basis points above forecast, it means the assumptions baked into your current pricing model, your current contract structures, your current capital allocation decisions may already be outdated, not by months, potentially by a full economic cycle. The businesses that survive monetary transitions are not always the largest or the best funded. They are the ones whose leadership understood the environment they were operating inside early enough to make structural adjustments before the pressure became unavoidable. This is precisely where silver's behavior becomes a strategic instrument rather than simply a market observation. Hard assets do not reprice violently in healthy monetary environments. They reprice when confidence in the paper system that is supposed to make them unnecessary begins to quietly erode among the participants who matter most. The institutional allocators, the sovereign wealth managers, the patient capital that moves slowly, deliberately, and always ahead of the public conversation. 10 bullish months in silver is that capital voting. Not with words, not with forecasts, not with television appearances or research reports, but with actual repositioning of actual resources into an asset that has functioned as a store of real value across more monetary crises than most modern financial models are even designed to account for. When that capital votes in one direction for 10 consecutive months, and then a PPI report arrives that confirms the inflationary thesis those 10 months were built upon, the serious decision maker does not ask whether the signal is real. They ask how much time remains before the signal becomes so obvious that acting on it no longer carries any strategic advantage. The answer, based on the weight of historical evidence, is that the window is not wide. Every major monetary repricing in recorded history has followed the same fundamental sequence. First, the data shifts quietly. Then the smart money repositions early. Then the charts begin to reflect what the data already said. Then the mainstream narrative catches up. And finally, the public acts. By the time the public acts, the early advantage is gone. What remains is participation in a move that others structured, others anticipated, and others will ultimately profit from most completely. Silver at $92 is not the beginning of that sequence. It is the middle of it. The beginning happened across the 10 months that most people were not watching closely enough. So what does the serious decision maker do with this information? They do not panic. Panic is the response of someone who encountered this information too late and feels the pressure of lost time. The analytical response is structured, deliberate, and forward-looking. They examine their current exposure to paper-denominated assets and ask honestly whether that exposure is appropriate for an environment where core producer inflation is running structurally above target, where hard assets are staging historically rare multi-month advances, and where the Federal Reserve faces the impossible mathematics of fighting inflation without breaking an economy that has become deeply dependent on cheap money. They revisit their pricing assumptions, their contract durations, their supply chain vulnerabilities, and their capital reserves, not with fear, but with the calm precision of someone who understands that economic transitions reward preparation and punish complacency with equal consistency. And perhaps, most importantly, they develop the discipline to read the signals themselves, not to depend on analysts, not to wait for consensus, not to act only when the headline confirms what the chart already showed 3 months earlier. Because the most dangerous position any decision maker can occupy in a shifting monetary environment is the position of permanent dependency on someone else's interpretation of a reality they could learn to read directly. Silver at $92. 10 bullish months. PPI confirmed. These are not isolated data points. They are a coherent sentence written in the language of markets by forces larger than any single institution and directed at anyone serious enough to stop, look carefully, and understand what is actually being said. The data has spoken. The charts have spoken. The 10 months have spoken. The only question that remains is whether you were listening